Netflix Incorporated. After experiencing a turbulent period in 2022 as a result of intense competition from other streaming services like HBO, Disney+, and Amazon Prime, NFLX appears to have regained the attention of investors. Regardless of encountering a decay, the stock has gotten back in the saddle. We should investigate the organization's essentials in front of its quarterly report, which is expected to be delivered after the business sector's close today. How does the business operate? Netflix is an entertainment service provider. In over 190 nations, the company offers paid streaming subscriptions. It lets members watch a wide range of documentaries, television shows, and feature films in a variety of languages and genres. On any screen connected to the internet, members can watch as much as they want at any time, anywhere. With no ads, members can play, pause, and resume watching. The organization likewise offers its computerized adaptable plate, DVD, administration via mail in the US. The organization offers an assortment of streaming membership plans, with costs shifting by nation and plan highlights. The monthly costs of its plans range from approximately $2 to $27. Content can be viewed by members on any internet-connected device, including mobile devices, smart TVs, game consoles, and TV set-top boxes. Content, including original programming, is acquired, licensed, and produced by the organization. Let's begin by looking at the balance sheet. The company's turnover and profits have increased consistently over time, with the exception of the year that was challenging for all tech companies. The company's performance in the upcoming year is yet to be determined. Over the years, the average margins have remained stable at around 30%, indicating that the business has successfully increased turnover without compromising margins. The impressive annual growth rate of EPSD, earnings per diluted share, has been 50% over the past 10 years. However, it is essential to keep in mind that these rates of growth typically cannot be sustained over the long term. Additionally, this raises some concerns regarding the expansion of the business in the foreseeable future. Netflix has over $6 billion in cash and short-term investments, totaling approximately $9 billion in current assets. When compared to current liabilities, around $8 billion, this is a healthy short-term balance. Again, the equity side is well balanced thanks to a manageable debt-to-equity ratio of 0.82. In terms of cash flow, the free cash flow and the operating cash flow have both shown varying trends. Despite recent improvements, the company's expansion in this sector is not yet robust. Maybe one of the potential turns that investors might want to see, likewise given impractical development rates for quite a while, is a more prominent spotlight on further developing income and long-haul supportability. The FCF yield is approximately 1% with an FCF of 1.6 billion, the most recent information available, which is very low but not surprising considering Netflix's cash flow issues. The company has a lot of room to grow in terms of this metric because, on average, a good level of profitability is between 8% and 10%. Based on the average of 12 different models, the stock is currently trading at a discount to its fair value, which is approximately $451 per share. The stock currently has an average target price of $357, indicating that analysts are cautious. There is very little room for growth at this price, which is close to the current value. As a general rule, nonetheless, as the viewpoint for additional development darkens, the center ought to move to productivity, not least on the grounds that the ongoing energy is one of the overall shortcomings across the tech area. It remains to be seen whether the new initiatives, the elimination of shared accounts and the inclusion of advertising, will propel the stock higher as we await the subsequent quarterly report.